Good afternoon, everybody. Welcome to our Short Verticals webcast. I'm Connie Hill. I'm happy to see you join me here today. How many of you have a good understanding of some of the Greeks involved with short verticals and feel comfortable using them? Or is it still kind of a mystery to you? Well, today we're going to focus on a couple of Greeks. We're going to focus on delta and theta a little bit. Hopefully you can understand them better and see how they might be useful to you as you're trading short verticals. Now, I hope you're following me on X. I am Connie Hill, CS, and I'll post educational content, typically most market days. Now, I am joined in the chat by Kathy Wynn. I'm happy Kathy is here to help maybe pick up some questions that I can't quite get to. Now, I'm going to keep an eye on the chat, and so will she. And so if you have those questions, go ahead, type those in. Now, there are lots of you that listen to this mainly on the recordings. And for you, when you have questions, go ahead and put it in the comments section of YouTube, because I go back and review those every day. Make sure you get your question answered quickly as well. So let's go through some disclosures and lay out our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes. Don't consider it a recommendation. We will be using the paper money software application of Thinkorswim. This is an educational tool, and I think it is super helpful as you're practicing strategies to do it on your paper money side so that you can get a feel for them before going into your live account. Investing involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An in-the-money option has a higher risk of being assigned early. One note of importance is that paper money does not do early assignments like the live market might. And so we want to make you aware of that and in situations where that might occur. Past performance of any security or strategy does not guarantee future results or success. All right, I want to give a plug for some events coming up now. I think we still have a few spots left if you want to go to the Market Drive event tomorrow. It's going to be June 13th at the Marriott Turnberry in Miami. A couple weeks after that, we'll be in New York, have a Market Drive event there. And then August 8th and 9th, we'll be doing a workshop, options and technical analysis in New York on the 8th and 9th. So if you can get yourself there, you will love it, okay? And if you don't, you can come and complain to me, but I think that you'll be happy about it. All right. We typically like to talk about short verticals and some aspect of how they work. Today, we're going to focus a little bit on some of the Greeks, the delta and theta, I told you. This is in a request from one of you. Last week, we had a survey, and you guys did awesome. You gave me a lot of information about some of the things that you're struggling with. I'm going to try to weave into our discussion here today at least 3 answers that came in on that survey last week. And one of those is having a better understanding of the Greeks. We're going to look at some example trades. We always like to do some follow-up there. And of course, we like to put in some new entries as well. Now, short verticals. We won't focus there. Short verticals are a strategy that some people might become their bread and butter strategy, meaning they like to do it day in and day out. Now, why would that be the case? Well, one, it can create some cash flow for you, and it can allow you to set up some higher probability trades. Not all trades are high probability. Okay, but some people might want to focus on that, and it generates a credit right up front, right when you get in the trade. You don't have to wait till the end of the trade to get paid for the trade. Okay, so there's some interesting aspects that short verticals give us. Now we're going to hop, what happens to the July workshop, Mighty Mouse? You're saying what happened to it? Let me go back. You know what? It's probably filled. Okay, I don't remember in what city that is, but it's not on the schedule because I think it might be filled. Okay, so good question. All right, Maximus Investor Guy says the Greeks are a partially solved mystery for you. Partially solved. Okay. Greg likes to be paid up front with things. The Greeks are a mystery to me, but I'm not a pro at it either. says Greg. Well, hopefully we'll just touch on the elements that really make a difference as far as short verticals go. Let's go out, take a quick look at our market, because we want to have that frame of reference. We're not going to spend a lot of time here on your market posture, okay? But you do want to know, are you feeling a little bit more bearish? Are you feeling a little bit more neutral? Feeling a little bit more bullish? Because that will make a difference in what strategies you pursue. And in the case of our class, are we going to look for short call verticals that are bearish or short put verticals that are bullish? Okay. Market, this is a 6-month chart. The blue line is my 10-day simple moving average, and the red line is a 30 simple day moving average. So an intermediate trend showing going bullish. Our short-term trend is showing bullishness as well. You know, and last week when we were here, when we were looking at the charts, it looked like maybe the markets were a little bit sideways, right? That they had been going sideways, the major indices, the SPX, the NDX. And, you know, it kind of looks a little bit different now. Because see, it kind of had been stuck in this pattern for a little bit of time. And then towards the end of last week, it started to take off a little bit more. Now today, the market's been up. Market's been a little bit down. Looks like right now it's up about 1/3% as far as the SPX goes. The last, I'm going to say 3 days here, maybe even 4, we might say, maybe it's falling into a little bit of a side consolidation again. We have to see a few more days, see what really happens. But overall, we're making higher highs and higher lows despite those moments when the market's a little bit flat. Let's look at the NASDAQ. We look at the NASDAQ as well because we use a watch list that is primarily from the NASDAQ 100 and the S&P 100, okay, for stocks that we have on our watch list. And as we look at NDX, similar type thing, right? Some higher highs, higher lows, got stuck in a little bit of a sideways pattern, and then kind of started to break out of it as well. And it is up about 0.29% right now. So we do have a green candle on the day. But as you're looking at this, it's not like the market's running up like it was through here, right? Where we had the MACD showing some strong momentum moving that direction. Right now, it's kind of creeping along, okay? I do think it's out of its sideways pattern, but it's still on the MACD side. It is still below zero, and really would love for it to come across zero and let us know that the momentum is really shifted. When the MACD starts rolling up, that gives us an idea that the momentum is starting to shift. But once it crosses over zero, then we can say, okay, it is more bullish momentum. It's not really there quite yet. Now, this is a place where short verticals really shine. Okay, they really shine because they work in sideways markets. They work if you're slightly bullish or slightly bearish, right? You could even be a little bit neutral in some of those strategies. Those two strategies could be useful in those markets because sometimes we don't get really strongly trending markets like we did back here in April and May. It was a strong bullish trend. So it's nice that we have this opportunity. All right. Let's take a look at a stock. Actually, I'm going to back up here for a minute. We've been talking about a process, and every week we've been following a particular process in our class here. In this process, we look at what the market's doing. Then the NASDAQ and the S&P 500 have been our main go-tos. We take a look at what the volatility is doing. And if I were to kind of zoom in here, more recently, volatility has been lower, right? As the market's been going sideways a little bit, so has the volatility has dropped from where it was up fairly high. And it's down, I'm going to say, in lower ranges, okay? What does that mean to you as an option trader? Well, if volatility is lower, number one, option prices can be, although they're not always, but they can be a little bit less expensive. As far as short verticals go, that means possibly they're not super juicy premiums. We could still find something that meets our needs, right? But when volatility is higher, that's when sometimes traders will shift to the priority of saying, I'm going to sell premium because it's expensive right now. And it's nice to be a seller in those kind of circumstances. Now, it's not as low, the VIX isn't as low as, say, what it was earlier in the year. Okay, earlier in the year, it was down there about 12, 13, kind of in that range where it was lower than where it is right now. But still, I'm going to say this is relatively low volatility. Now, Kathy has chatted into the chat here a webcast that was taught recently about the Greeks. And I think this one was Brent Moores that did this. I'm not positive. Called Back to School with Option Greeks. All right. And going through them a little bit. Now we're going to look at a stock, and then we're going to go look at the Greeks for this stock. Okay. First one we're going to take a look at here is Marvell. Now, Marvell is on our watch list, and all the stocks that we trade in this class come from this watch list that we update about once a month. Last time we updated this was on May 29th, and so these are the stocks that are on that list. It's probably in the neighborhood of about 40, maybe. If I come back. All right, sounds like the audio conked out for a little bit on us, unfortunately, but I think we are back, so that's good. This column here is the 1 week return, and that is a ThinkScript. This one is a 1 month return. Okay, again, it's another ThinkScript, and I have those ThinkScripts. I have the 1 month right there, and I'll copy that over to you for those of you that do not have that. And let me just chat that in right there. Anytime we share a script with you, remember, it is not guaranteed as to accuracy or timing. Okay, so that's the 1 month. And I don't think I have the 1 week one sitting out here on my platform. So let's just go look at it real quick. I'm going to do a customize, and I'm just going to click on this script here of the 1 week percent change. And that's going to bring up the script. It's a really small script. It's not really all that detailed. It's mainly just counting time frames. So I'm going to hit share. It's going to create a link here. I will share the 1 week with you here as well. Okay, so that's what that second one is. And I'm going to paste it down here if I can. Let's just say, okay, I'm going to paste it down here in my chat with my other scripts. Oh, it wants me to get totally out of there. Okay, I'll get totally out. All right, and this is going to be the 1 week. I'll just make a quick note here, okay?
Hello, folks. I am back. I apologize for the audio difficulties I'm having here today, but I am back. The sound might sound a little bit different because it's coming from my phone, but let's proceed here. We were talking about our class watch list that we are using here and what these couple of columns were. Today I sorted it on the percent change. Now, any of these stocks we can use in a bullish direction or a bearish direction, just depending on what the trend is. Mainly, we're looking for liquidity in these options or in these stocks. We want lots of option activity, and we don't really care where it comes from on the list as long as we can trade it and there's liquidity here. Now, the first stock I was going to have you look at here is Marvell. And on Marvell, it has started an uptrend. We have some higher highs, higher lows, okay? Today, it looks like maybe it's pulling, maybe trying to bounce here out of a little bit of a pattern. I had drawn a flagpole up, and the stock was up a little higher earlier, and it looked like maybe it was trying to break out of that flag pattern. Might not be quite as convincing at this time of the day. But when some traders are looking for getting into a position, sometimes, especially in short verticals, they don't mind going back to support. They might not necessarily have the breakout of the flag yet, which is completely legitimate, right? We love to see those. And we look at any of these potential bullish entry signals. Support bounce, close above the high of the low day, a bounce off of a moving average, or a breakout above resistance or out of a pattern. And I could add down here, I could say sitting at support. Okay, and we might kind of look at this one more so, all right, that it's kind of sitting at support here. If we come back to say, actually, let me just zoom out a little bit. We can see, yeah, the 67-ish area acted as support for all through this period of time here, ran up to it as resistance here about 3 times before finally breaking through. So this is going to be our first example here today. And so let's come over here to the trade tab. And let's come over here to our July options. Now, we're going to continue down the path of, we've looked at our watch list, we've identified a stock that has a bullish entry to us, so now we're going to the option chain to identify, what we want to work with. And many times traders love the window, 20 to 40 days worth of time. Sometimes we have to go out to 50 days worth of time, just kind of depending on how the options are rolling out here. Now, you can see here I have open interest column here. We're looking at short put verticals, so we're going to look at this column here. Love seeing thousands. When we see lots of them here, then we typically see the options trading in penny increments. We love penny increments, right? It means that the stock doesn't have to do a whole lot before we start I'm going to say becoming profitable in the trade. Now, I'm going to switch this over. We're going to turn this column over to the Greeks, delta, gamma, theta, vega. One of the concerns that some of you have had is really knowing how to use the Greeks. How are they really all that helpful? Okay. And we use it when we're trying to choose a strike price. Now, just kind of generically, what delta means is what is the likelihood of this option expiring at least a penny in the money come options expiration day, which in this case is July 18th, so it's the options we're looking at. So, for example, this 50 strike price, it has a 0.03 delta. There's a 3% chance this option could be in the money come options expiration time. And the further we come to at the money and in the money, that delta gets a little bit bigger and a little bit bigger, right? So say on this 85 strike price, it's a 90 delta. There's a 90, oops, that just changed to 24 or 84, but there's a good possibility it would expire in the money. Now, when we're trading long options, we want it to expire in the money. When our main driver of our trade, like on short verticals, is a short option, we don't want it to expire in the money. We would love for it to expire out of the money. So just kind of generically, delta has been used for what's the likelihood it's going to expire in the money. We would love it to not expire in the money. And so 30%, 20%, 15% we like that ratio, right? Because we don't want it to expire in the money. Now let's talk about theta for a minute. Theta is a big driver in a short vertical. It tells us every single day how much time decay that price of the option is going to experience, okay? So we're going to look at this 65 here, okay? It just came in the money. Looks like it has it's out of the money, actually. The daily time decay is going to be 5 cents. So every day, this option is going to lose roughly 5 cents. That includes Saturdays and Sundays and holidays, as well as the regular weekdays. Now, I'm going to compare this to the options that expire tomorrow. Okay? And we're going to come over here. Here's the theta value. And if we look at this here, something close to at the money, it's a 39 cents. It's going to decay every day. This one's going to decay 59 cents. Okay? And so that is a huge difference. So the closer that option gets to options expiration day, and of course these ones are really close, right? The more that time melts. This little graph here, we're graphing, say, time decay. And this line at the bottom is options expiration. The closer it gets to that expiration, the more quickly it melts. Okay, so it's kind of like you're taking an ice cube, you're putting it over a burner, a fire, and you're just watching it melt. And when it gets really close to options expiration, yeah, these deltas are significantly larger than when we have a lot of time. And so we're going to go back here to the July options where the theta is relatively small. Now, if you put on some positions and you watch, one thing you will notice is the change of the theta over time, right? All of a sudden, it wasn't just today that all of a sudden this theta became bigger, okay? It wasn't, all of a sudden, but it graduates. It gets a little bit bigger, a little bit bigger. We notice the biggest impact of theta on the at-the-money options, okay? When it goes a little bit in the money, not as big of a concern. And sometimes you get way out of the money and there's hardly anything in there, okay, as far as time decay goes. Now, we're going to put together this trade. On the July 18th, we're going to go 65.60. So I'm going to say sell vertical. And I chose this particular one because generally speaking, if somebody's trying to set up a higher probability trade and then they want that to expire out of the money, and so if it has a 31% chance of expiring in the money, then there's roughly a 69% chance that it would expire out of the money. Great. We love that number. Now, something that I have in my default column structure that we look at typically, I almost always have the delta because that's a big one. I don't usually have theta on there, but it's easy to switch back and forth between the two. And then I have another one here. Let's see, I clicked on the wrong, well, let's see. Custom column sets. I created a new one. That's interesting. Okay, I'm going to customize our column set. It may have wiped out when I had in here previously with this new update because now we can save column structures not only in here but over in the watch list area and the over here on the market watch and quote window. Okay, so this is what we're going to do. We're going to get rid of gamma. We're going to get rid of theta, even though we've talked about it here today. And we're going to put on open interest because we want to know how many contracts are out there. We want volume, which is today's activity, and sometimes that can make a difference. We'll add that. And then let's add probability of expiring out of the money. Okay, probability of expiring out of the money. We're going to add that, and that's all we're going to use right now. Okay, and so that delta, yeah, it's really handy to have sitting right there. Window, generally a 30-something delta. Now this is interesting. I told you 1 minus 31 would be about 69. And what's the probability of the option expiring out of the money? It's close to 69. It's 62 and change, almost 63, okay, is that probability of expiring out of the money. And typically for a high probability trade, we say 60 or over is a higher probability trade. All right. Now that you've been going through the process with me over the last few weeks, what's the next step? What is our next step after we identify a 30-something delta that we decide we're going to go with? I'm going to come in here. I'm going to lock the price here. We are going to have a maximum gain of 132 per contract. What's our maximum theoretical loss? 5 minus 1.32. Okay, that gives us a value of 368. So I'm just going to put that down here. 3.68 is our maximum theoretical loss on this. Now, with short verticals, you do need to recognize that we are going to risk more, 368, than what we have to gain. Okay, $1.32. Why would somebody do that? Because of the high probability trade. Okay, because right now there's a 62% chance that the trade will go our way and expire out of the money. Okay, so that's why people might do that. In our class, we're willing to risk $1,500 on any trade. So we'll take our $1,500, divide that by our max theoretical loss of 368, and that tells us how many contracts we can do. Okay, so we can do in this scenario, we can do 4 contracts, and we're going to put this as a first trigger sequential order. I'm going to have to move this up. Not sure why it's down so far. Maybe if let's do this. Let's create an opposite order here. I guess I'm used to it being up a little bit more, but this is fine. We can see it. When we get a majority, we get a chunk. One exit rule that some traders like to use is if they get a big percentage of what their max gain was, so a big percentage of 132, they'll get out of the trade early. We've looked at different trades that we've done that on, okay? And a lot of times, not every time, there's always going to be some exceptions. Many times they work, we are able to get out of them fairly quickly, well before options expiration date. In fact, last week, the 3 trades we followed up on, all 3 of them got out that next week before we met together again. Okay, so let's take our 132, and if we can get 70% of it, that means only 30% is left. Let's multiply that by 0.3, and so we're going to say we're willing to buy it back here at 0.39. And let's make this a good till cancel here. And we're going to send it off. It's a bullish one, so we're going to put it in our bullish short verticals bucket. Now, let me ask you, having gone through a little bit of detail about the Greeks, do you feel a little bit more comfortable with that? Okay, knowing what this delta represents and understanding theta isn't as big as you're far out. I mean, when you're further out, and then when you get closer, it gets bigger and bigger. Feel free to give me some feedback in the chat, okay? Yeah. All right. Let's do another one here, and we're going to fly through it a little bit more quickly. We're going to pull up Pan W. Now, Palo Alto Networks, it's, if I were to back out here a little bit on it, would also see, let's go a little bit further in time. Let's go for a full year. All right, kind of been all over the place. Upward trending for a while, had a couple of periods with some significant pullback, but then more recently, it's put in this pattern of higher highs and higher lows. 208 was its high back in February, but what's it doing right now? Okay, it's broken above this 195 resistance, and then it acted as support here. You can see this, can't you? It has just been acting as support. We could also, if we wanted to, I'm going to zoom in a little bit more, we could draw a flagpole here, going from this candle up to this candle, because it's mostly a straight shot up. It does have one little sideways day there, but mostly it's a straight shot up. And then it has a little pulling back action. 2 to 5 days is ideal. Sometimes it lasts a little bit longer than that. And then what are we seeing today? We're seeing a couple things, either a breakout of a flag, okay, or a bounce, kind of a retest and a bounce off the support level. So we've actually got 2 of the signals that we might look for when we're looking for a bullish breakout, okay? Let's go to the trade tab. Let's go, we're going to use our July options. But I'll tell you, I picked through the weeklies. They didn't have as much open interest as I typically like to see. So when that's the case, man, I just go out to the monthlies and don't worry about it. Okay. We're going to use our delta column again to find a 30-something, 40-something, maybe lower 40s, higher 20s delta here. We do have the 195 that's a 40 delta, and that's about $2.91 away from the current price of the stock. This one, if we sold that, would be probably a little bit nicer return. Let's see if we can get at least something that's acceptable using the 29 delta. Okay. Notice all the open interest here. We could trade any of those contracts and not be worried unless, you trade 1,000 contracts at a time, then that might be an issue to you. But if you're trading even 10, 20 contracts at a time, you're just fine. And we're going to position size this. So we're going to do a sell vertical. Again, we're choosing the 29 delta this time. And what's the probability of it expiring out of the money? Well, right now about 68%. Okay, so a little bit higher. The trade-off is we might not get quite as good of a return. Now I'm going to lock that in and let's go find out. If we take 5 minus $1.13, this is going to give us our max theoretical loss, which now is going to be, I guess I'll just use this area, 3.87. That's our maximum loss on this trade. So then we say, all right, is it going to give us a good enough of a return here? Is it going to be worthwhile for us? So we'll take $1.13, divide that by 3.87. That's going to give us a 29% return. Now, some people are going to be okay with that. There might be some people that aren't. Some people might say, I only will accept something 30 or higher, or I only will accept something that I'm getting at least 1% for every day that the option has left to live. Okay, that's going to be up to you to experiment with in paper money and kind of get a feel for what you're good with. All right. In this case, let's see how many contracts we can do. 1,500 divided by 387. That's what our risk would be. We can do 3 contracts, almost 4, but we're gonna do our position sizing the way we know to. First trigger sequential. We're going to put in an opposite order here, and we're going to go figure it out. Again, when we get a good chunk of this, all right, let's make this big chunk be 75%. So if we have 75%, only 25% is left, so we'll multiply 0.25 times 1.13. That'll say go buy it back for 28 cents. So we're not trying to bleed every little penny out of this spread, okay? We're just looking for a chunk of it, a majority of it. And you could change this as the trade develops over time. You could come out here and adjust it. All right. Let's see here. Let's go ahead and send this into our bullish bucket. I'm going to send it on away. Let's see here. I think there's a question here from John. I'm trying to work it out here. John had maybe asked something that you guys were trying to help him with, and I'm not seeing exactly what it is. Here it says, so you use the delta to choose the short leg, yes. Then the other leg, simply 5 or whatever, the lower strike for protection. You can go $5 away. This one happens to be $5 away, right? 190, 185. Sometimes in the weeklies, you're going to have dollar increments. Okay, if we come up here and look at, say, oh, that's not a weekly. We'll just look at the weeklies today, and it's in $2.50 increments. Okay, so sometimes you can take that increment. Sometimes you might look at it and go, there's not enough open interest in it. Let me just go a little bit further out so I have enough open interest for it. All right. I want to touch on one other thing, and I wasn't able to show you as much as I wanted to here today. Okay, but we're going to hop over here to our Trader Talks. I hope all of you have become subscribers. All right. One of you has a great interest in finding out about 0 days to expiration options. Okay. If you are subscribed, you get this window, and it makes it so much easier for you to find our content. What I'm going to do here is I'm going to say, okay, let's see what videos we can find with 0 DTE as a topic in the title, okay? And not everybody has to be interested in 0 days to expiration options, okay? But you can see Brent taught a class on it recently. Ben has taught several classes on 0 days to expiration. We talked about it a couple of weeks in a row. We talked about it February 20th, okay? So for those of you that are looking for more information on that, that is how you can easily find it. And of course, being a subscriber helps you identify that a lot more quickly. All right, I apologize for the issues that we had here with our sound. That was not fun. But let me just give you a quick summary. We did a couple of new trades, 2 new short put verticals. We're looking a little bit more bullish. Marvell, we did a 65.60 short put vertical. PanW, we did a 195 or 190.185, I believe is what we ended up with on the strike prices there. So we're going to track those. We're not going to follow up on any trades today because of the issues we had, but bottom line is they need to work. They're trades of patience sometimes, and right now, the trades that we have in process, that's exactly where we're at, is we're just letting them work. They're working a little bit, but need more time to decay, and those options don't expire till July 18th, okay? So we've got plenty of time for that to happen. All right. Next up is going to be Think Scripting, or Scripting Studies, I believe is the actual name of the class, with Mike Fairborn. He's teaching that class now. And somebody wanted to know something about labels as scripts. That's something that Mike has taught in that particular class, the Scripting Studies. So if you were the person that wrote in and said, hey, I'm interested in learning about putting some labels, I was hoping to show you that today, but Mike's class actually might be a little bit better for that. So he'll be coming up right at the top of the hour after we have just a quick 15-minute break. So get a snack, and appreciate you hanging in here with me, guys. We'll follow up on these trades next week. Subscribe, follow. If you found this useful, go ahead and hit the thumbs up button. Thanks, everyone. Bye-bye.